Welcome to our presentation on financial literacy. In today's complex financial world, it is essential to have a solid understanding of personal finance to achieve financial stability and security. So, here I'm going to discuss about financial freedom fighter. Today, I will talk about how to break free from financial struggles and become financially independent. Financial freedom fighter is a person who is actively work to overcome the financial struggle, and he focus on wealth building and financial independence and use smart financial strategies. And also he is someone who value financial education and personal growth. In simple terms, it means that it is about taking control of your money instead of letting money control you. So, the next is the enemy in the financial dependency. The common financial struggles we are facing are living paycheck to paycheck, having high debt and interest payment, and not having emergency savings, and there is no clear path to retirement and limited financial choices. If we don't manage the money well, we stay stuck in a cycle and we always struggle financially. So these are the enemies in the financial dependency. And the next is financial freedom arsenal. So these are the key tools for making a financially successful. First of all, budgeting. It is including tracking income and expenses, debt reduction, pay off high interest debt firstly, then emergency fund. We should have a save of 3 to 6 months worth of expenses. Then investment strategy. We should have an investment strategy that will have a grow wealth over time. And the next is multiple income streams. Earn money from different sources. So it is just like a soldiers have weapons for their battle, we need these financial tools to win against the money struggles. So the next is the battle plan, the 5 key strategies to become financial success. So first of all, we need to know your numbers. We should track the income, expenses and net worth. And we should always try to maximize the income. We can grow our income through the skills, promotions and side hustles. Then we should always try to keep the expenses to be minimized. We should cut the unnecessary spending. Then build assets. Invest in the things that grow in value. We should always try to build assets in future. And the next is project your progress. We should always use the insurance, tax planning and estate planning in our finance structure. These 5 steps will always create a strong financial foundation for us. And the next is the milestones of financial freedom. So it is mainly the different levels of financial freedom. First level, debt free. Level 2, 6-month emergency. And level 3, consistent investment. And level 4, passive income covering basic expenses. Level 5, financial independence. So in level 1, it is the debt free. It means that we should accept the mortgage. And in level 2, it is the emergency fund. It should include the 6-month emergency fund. And in level 3, we should have an investment of 20% of the income, 20% plus of the income. And the next is passive income. Passive income should covering all the basic expenses. And in the level 5, it is the financial independence. The work is optional. So the financial freedom is a journey with clear steps. The goal is to reach a point where money is no longer a constant worry. So the next is some common obstacles and how we can overcome them. So the common obstacles we are facing are knowledge gap. So people is not having enough knowledge about the financial stability and the financial success, how to gain the financial success. So we should have a continuous learning about the money, how to manage it, how to recover. Next is impulse spending. It is about automate savings and take time before making purchases. So we should spend before we are spending. We should take time to think that. The next is lifestyle inflation. There is a spend based on value, not just income. And the next is a market volatility. So we should invest for a long term. Rather than we are focusing on a short-term investment, we should always focus on the long term. So the future will increase in future. Then peer pressure. Surround yourself with financially smart people. We should always surround ourselves with a financially independent, financial knowledge people, so we can overcome all the obstacles. So these are the common struggles, but with the right mindset, we can overcome them. So your personal financial definition. First of all, you need to define why do you want a financial freedom. And after that, we need to set a SMART goal. We know that the SMART means S stands for specific, M stands for measurable, A achievement, R relevant, T time. So we need to set all this, and after that we need to implement the system, build system that is automatic savings and investment, then celebrate progress. Small win also matter. So we should celebrate the small victory and remember that financial freedom is we will have more choices in our life. So this journey, financial freedom journey, is personal. So set your goals and take small steps daily. And the next step, encourage immediate action. So as a call to action, you should always assess your current financial situation and identify your next milestone. You need to choose your next financial milestone, then find accountability partner, then schedule monthly financial check, and also join a community for support. So start today. Even small steps will bring big results over time. Thank you.
Today we will be dealing with a new topic, a new financial literacy topic known as FinThrive. That means that thriving beyond financial literacy. So it basically means that beyond saving towards financial growth and resilience. So question arises is that are you just managing money or is your money working for you? So question for you all. So basically FinThrive means a blend of finance and versus plus thrive, meaning that not just surviving financially but flourishing. And why it matters. So financial literacy teaches about the basic money management, and FinThrive teaches about the best acceleration and resilience. So FinThrive is basically giving a option that not just saving but beyond thinking about financial literacy with future terms. So here we can see a shift from financial literacy to FinThrive. So in financial literacy we'll be focusing on budgeting, but in FinThrive we'll be focusing on wealth building. And financial literacy will be mainly focusing on avoiding debt, but in FinThrive will be using a smart borrowing or investing opportunity. And basic saving to passive income creation and emergency fund for financial independence. These are the main key elements when compared to financial literacy FinThrive is focusing on. So next we'll be moving on to some examples for clear identification of understanding. First example is about a traditional saver versus the FinThriver. So here the traditional saver saves say 500 rupees per month in savings account. So here he will be getting a minimal interest. He is earning a minimal interest. And FinThriver, he invests 500 per month in stocks, real estate, and etc. So here he will be earning a compounds into wealth. Second example is saying about a side hustle to financial independence. So considering Sarah as a teacher, she starts a YouTube channel on education tips. And within 2 years, she is earning more than a teaching salary from YouTube. So what she done is that she invests that earnings in stocks and rental properties, and here she is earning financial independence. So from these two examples, we can identify that FinThriver is not just saving and creates an opportunity to save beyond the savings level, the future level. So both there is having a financial independence and another earning a more minimal income. So there are three basic pillars of FinThrive. The first one is wealth acceleration. Wealth acceleration means that earning beyond a salary, what we have currently now. Second pillar, focusing more on the financial resilience, means that handling setbacks with emergency funds, insurance, and adaptability. The third pillar is smart financial flow. It means that automating investments, optimizing expenses, and maximizing returns. So, are you in doubt with how to start FinThriving? So, if you want to start a FinThriving, there are 4 steps to be maintained. The first step is move beyond saving. So, we have to think our level from thinking into investment opportunities and income streams. How we can be able to invest, how we will be able to get income. Next is develop financial resilience. It means that emergency fund, insurance, side hustle skills, how to develop and earn income. Next is build a money growth system. It means that how to allocate your savings money or how to allocate your money into different streams so that you will be earning more than the savings money. So it is automated saving and investing. Last step is upgrade your money mindset. It means that shift from making ends meet to creating financial freedom. You have a financial freedom to choose what you want, to depending upon your choices. So as a concludatory part, the future of Intra. So we know that financial literacy is focusing on the past events or the past steps, whereas Intra was focusing on the future reports and future aspects. So here the question arises that are you just surviving financially or are you thriving? So the main key idea with beyond Intra is that rather than saving for a short period of time, it's better to have it in thrive. That means that keeping the idle money into different streams so that you'll be getting more money in it. So for that we have to start investing and build multiple income streams. Like we have seen some examples of earning money to investing the money in stock markets, the real estate and all. So that is building multiple income streams. And last is take control of your financial destiny. So you have to create a different plan on how to allocate your resources and how to allocate your plan in a well manner so that you will be getting more money. So that's it about the future of Intra or the basic concept of Intra.
So our new financial literacy term is Robo Advisory 2.0. Robo Advisory 2.0 is the next evolution of automated investment management technique. For an introduction, Robo Advisory 2.0 is the next generation of automated financial advisory service incorporated AI, machine learning and hybrid model for personalized financial planning, and it offers more dynamic and real-time decision making and customized investment strategy. In simple terms, Robo Advisory means Robo Advisory 2.0 represents the next phase in the evolution of digital investment platform of financial literacy, and it moves beyond basic automated portfolio management and to incorporate advanced AI, machine learning and automation for smarter, for personalized financial planning. For key innovation in Robo Advisory 2.0, first one is AI-powered decision making. It means that they will help for AI decision making for learning smarter asset allocation, and it helps to adapting to real-time market changes using AI and predictive analysis. And second one is hybrid advisory model. It means that it helps to combine Robo Advisory with the human financial experts, and it give more financial exploration. And the third one is behavioral financial integration. Behavioral financial integration means it helps to understand user psychology to guide investment choices, and it will help traditional Robo Advisory to use more simple for portfolio for the allocation. And fourth one is blockchain and smart contract. Blockchain and smart contract means it gives more transparency and security in transaction. Moreover, and it gives more decentralized. It gives more decentralized prevented to common financial market, and it ensure transparent and we can secure our transaction, and it give more security to our transaction. And for example, instead of recycling of traditional brokers, a smart contract can automate dividend payment to execute trade security. And third one is next is advantages of Robo Advisory 2.0. The main advantage of Robo Advisory 2.0 is it is more personalized and adaptive investment strategy that it can be used any time, and it is more adaptive strategy for our financial. Like AI can trail investment recommendation based on users' financial goals, risk appetite and life events. For example, AI invested savings for a home get excessive growth strategy, while repair may get low risk income generate. Through that income can be generate. And next is faster and real-time portfolio for rebalancing. That means it gives more constantly monitor the market to optimize investment performance. Next is improved security and trust with the blockchain integration. That means it give more it ensure data integrity by making transaction and verifiable, and it reduces risk of fraud and hacking on the data batches. For example, investors can verify every transaction history through a secure and decentralized ledger. And next is accessibility and industry. A greater accessibility through AI chatbots and digital assistants. It means that they will provide financial advice to users of all backgrounds, make wealth management more accessible for beneficial for young investors, low-income individuals, and through with a limited financial knowledge. For example, all the investors, a small investor can receive professional investment without very expensive personal financial advisors. Challenges and consideration. Challenges. First challenge is increased reliance on AI may reduce human oversight. There is no movement, so there is an increased reliance on AI. Data privacy. It is used by AI machines, so there is no some circumstances there is no data privacy. Regularity harder for AI-driven financial decision making. And next is need for continuous technology upgradation and cyber security improvement. For future trends in Robo Advisory 2.0, there is a greater integration of generative AI for advanced financial technology, expansion into holistic financial wellness beyond investments, use of decentralized finance for automated wealth management, or hyper-personal using real-time behavior data. For a conclusion for Robo Advisory 2.0, Robo Advisory 2.0 is transforming financial planning with AI automation, and it's a blockchain security. It offers benefits for personalized investment, moreover enhanced security and financial inclusion. Challenges remains such as there is a challenges also that remains like data privacy concern, cyber security, regularity issues, and need more human oversight.
Hi all, today I am presenting a financial literacy term, that is bonus cap. This means that an overview of bonus cap regulation and implications. Going to the introduction to bonus cap. A bonus cap is a regulatory limit on the variable compensation or bonuses that employees, particularly in the banking sector, that can receive. It's aimed to prevent excessive risk taking and also promote financial sustainability. Before going to why the bonus cap introduced, for example, I'm briefly explaining an example for more understanding. If a banker earns a salary of ₹1 lakh and the cap set is 100%, their maximum bonus is 1 lakh. This prevents an excessive risk taking and driven risky investment. So, why was bonus cap introduced? We introduced in 2018 to scrub excessive risk taking and ensures a responsible compensation structures, and it also promotes shareholders and customers from riskless financial behavior and strengthen the financial stability and regulating compliances also. And next, going to the key features of bonus cap, typically applies to banking and financial institutions. It is limited to a multiple of fixed salary, example 2x of a basic salary. In some regions, it aims to align employees' incentives with long-term company performance. It often applies to senior executive positions, and it is often based on performance without regulations. But regulations, employees might take high risk to earn more bonuses. This destabilize financial institutions. Recent changes in bonus cap. UK removed the bonus cap in October 2023 and allowing to set their own limits. In 2025, Lloyds Bank Group set a cap at 8 times with the basic salary, regulating the shift to move toward and making the performance and compensations. The pros and cons of a bonus cap. Pros means reduce excessive risk taking, promote financial stability, ensures a fair competition practices, and the cons may limit talent and attracting competitive market, could encourage firm to increase a fixed salary, and instead of it is also reduce a flexibility in performance. As a conclusion, bonus cap regulation aims to a fair compensation fixed with financial stability, and recent regulatory changes reflect shifting priorities in executive pay. Companies must navigate these rules while maintaining competitive incentives. An ongoing discussion continue on effective such regulations. To reduce riskless financial decisions by employees, ensures financial stability, prevent economic downturns, encourage and long-term growth rather than short-term profit seeking, and also align incentives with company goals rather than excessive risk taking. Without bonus cap, employees are incentivized to focus on short-term gains rather than long-term stability. 2080 crisis is a prime example of these issues, and also for more understanding a real life example, that is, imagine a trader, he takes a high risk in the stock market to earn bigger bonuses. If their investment fail, the bank loses money and the economy can be negatively impacted. I hope you understand this term. Thank you.
Today I am going to present the financial literacy terms, quantitative easing. So basically, the quantitative easing, a monetary policy strategy, is mainly used by the central banks to stimulate the economic growth and combat deflation. So, next, how its QE works. So, the central bank purchases and increased money supply lowers interest rate. So, the central bank purchases the long-term financial securities like bonds, primarily bonds, mortgage-backed securities, and the commercial banks and financial institutions. Then increased money supply. So basically injecting the new money into the economy, so it will be QE, increasing the overall money supply, making it easier and cheaper to bank to lend. Then lower interest rate. Basically with the higher liquidity, the interest rate drops, making the borrowing cheaper than the interest rates, encouraging the business to borrow and invest in new economic activity. Then major QE programs in worldwide. So basically in US, the Federal Bank Reserve implemented the several QE programs in 2080s. Basically the financial crisis totaling the almost 3.7 trillion, and the ECB, the European Central Bank, launched 1.8 trillion quantitative easing program during the COVID pandemic. And the Bank of Japan in 2013, the engaged in continuous quantitative easing in 2013. Their cumulative total exchange is 700 trillion. So the economic impact of QE. So the interest rate will be impact on QE. So long-term interest rate typically 0.25 and 0.75 introduction of long-term interest rate. So the next is market gains. So the QE associated with the stock market gains, like that 60% rise in the S&P 500 in QE, and the real estate price increases. Always that they will be increasing the real estate price, that it will be linked with the real estate prices. Estimated that 10 to 15 gains during this period. Then currency value effects. QE can lead currency depreciation, then typically around 5 to 10 to invest their higher returns to the markets. Then the QE success story. The first is the US recovery post 2008.
achieve the 2% of inflation target. Then next is the stabilizing the eurozones during the sovereign debt crisis. Then the Bank of England, their programs help to maintain the financial stability with the UK Brexit uncertainty. Then the risk and criticism of QE. Then the assets bubble formation. The interest rate can be increased the excessive speculations. So the wealth inequality concerns. So the QE is disproportionately flow with the wealthy exaggerating excessive inequalities. So given the economic gaps, or if it is a wealthy benefits, and then it is inflation risk. It can be affect the inflation risk. So as it is evidenced by 7.7% plus the consumer price index. Then it will be increases at 2021 and 2022 year. The market dependency. So the market become increasingly reliant on QE because the banks began to reduce their supply. Then what are the QE exit strategy? So basically the balance sheet reduction. Balance sheet reduction, the QE will likely continuing adapting the economic technological changes. That will balance sheet reduction and the gradual tapering. Gradual tapering means gradual tapering. So this strengthen central banks gradually reduce the pace of QE purchases. Then it will be allowing to the adjust their monetary stimulus. Then market reaction. So the 2013 the taper tantrum demonstrated the potential market volatility during the quantitative easing exit strategy. Then communication strategy. So the basically the clear and transparent communication from central banks helps them minimize their market disruptions. Then future QE. Then after that the future will be also increasing. Then evolution of monetary policy. The new evolved new and changing the economic condition and technological advancement. Then digital currency implication. So the mainly Paytms, Google Pay. So this digital currencies may influence the QE implemented impact on the economy. Then environmental conservation. So the potentially the policy makers are evaluating the sustainability of QE policies and policy approaches. So preparedness of crisis. So mainly the QE expected to remain the key tool in addressing the future economic downturns. So basically the QE is, if it is suppose, for example, if the economy is facing recession, then it will be disadvantage to implement the QE quantitative easing. That will be effectively useful for the conclusion. So the QE can be for the conclusion. So the QE can be a monetary policy tool. Basically, it will be successfully stimulated. The economies can prevent the deeper recessions.
So today's topic is home tower insurance, high savings account and fiduciary duties. Home insurance is a significant investment and protecting that investing is important. Home insurance provides financial securities by covering damages, losses and liability related to home. Example, if a fire damage your home, home insurance helps cover the repair cost, preventing financial hardships. Definition: insurance that cover home structure, belongs and liabilities. Home insurance is a policy that provides financial protection against losses and damages to a residence, and it's conducted and its conduct. It also includes liabilities coverage for accidents that occur on a property. Why it is important? It covers disasters like fires from theft, and it required
by mortgage lenders and provide liability protection, helps with emergency expense. Disaster. Choosing the right policy. Assess coverage need based on location, compare quotes from different insurance, understand higher deductible equal to lower premium, and check for discount. Example, your kitchen catches fire due to a gas leakage. Home insurance cover the repair and hotel stay while repairs are made. Next, high yield savings account. High yield savings account is a type of saving account that offers significant higher interest rate that traditional savings account help your money grow faster. Provide a safety and a liquid way to grow money. Benefits of a high yield savings account. It is high interest, FDIC insurance, and easy access and minimal fees. High yield savings account under home insurance helps cover insurance deductible and act as an emergency fund from home repairs and reduce financial stress during home related emergencies. Choosing the best high yield savings account. Looking for high APY, aim for 4% to maximize earning and avoid maintenance fee. Some bank charges maintenance fee that reduce the interest earning. Then check withdrawal limits. Some high yield savings account limit the number of withdraw per month, and consider online banks for better rates. They often offer high APYs that traditional banks. Example, Ally Bank's Marcus by Goldman and Discover Bank often offer competitive high yield savings account with the number of fees. Next, fiduciary duties. It is a legal obligation to act in another party best interest. Who has fiduciary duties? Financial advisor, executors of estate, and corporate directors. That's it. Thank you.
So have you ever heard the word overdraft fee regulations? Some might have, some might not. So overdraft fee regulation, it's protecting your money. A little awareness can save you a lot of money. So what is an overdraft? An overdraft happens when you spend more money than you have in your bank account, and the bank covers the difference, often charging you a fee. For easy understanding, I will give you an example. If you have rupees 500 in your account, but you make your rupees 700 purchase, the bank covers rupees 200, but you may be charged a 300 rupees overdraft fee. This is called overdraft. So has this ever happened to you? Overdrafts can be helpful but also costly if you are unaware of the fees. That's why we have regulations. So why do overdraft fees exist? Bank charges overdraft fees to cover the risk of lending money temporarily. Fees are meant to encourage responsible lending but can sometimes be excessive. For example, a rupees 100 coffee purchase could cost you rupees 500 if overdraft fee is applied. So next is opt-in rule. Your choice matters. Before 2010, banks could automatically charge overdraft fee. Now you must opt in for overdraft protection. What happens if you opt out? The pros are no overdraft fees, transaction may be declined instant. Cons are your transaction might be declined at checkout. Opting out means your card might be declined, but it also means no surprise fees. So how to avoid overdraft fee? Track your spending, like use banking apps.
is low, linked to sale. Some banks allow automatic transfers. Opt out. If you don't want overdraft fees, decline the service. A little financial planning can help you avoid overdraft traps. Before moving to the conclusion, I will give a real life example. A student accidentally overdrafted rupees 50 but was saved from a rupees 500 overdraft fee because they had opted out. Awareness and choice can help you avoid unnecessary charges. As a conclusion, overdraft can be useful but costly if unchecked. Regulations exist to protect consumers. Know your opinions and make informed choice. So always read the fine print. Your wallet will thank you.
So now we will discuss on a very unique term, which is known as credit crunch. As the term specifies, it's something related with the credit, which is given by the banks especially. And we'll look into it in detail. First of all, introduction. A credit crunch means a sudden reduction in availability of loans or credit. It happens when the bank tightens lending standards, making borrowings difficult. So why is it important? It affects business, individuals, and economic growth. Also, it has led to a major financial crisis in the year 2008. And some of the causes of credit crunch are excessive risk taking by banks. Loose lending practices lead to bad debts. When the bank has a loose lending practice, it obviously leads to bad debts. Asset bubbles and crashes. There is overvaluation of assets which leads to collapse. Example, real estate bubbles and all. High default rates. Borrowers fail to repay loans, increasing banking losses. Regularity changes. Stricter banking rules reduce lending flexibility. There will be a very demolished or very strict rules can lead to lending flexibility. Global economic uncertainty. Recession fears cause banks to hold cash. Effects of credit crunch. Business struggle. Harder to get loans for expansion. Then job losses. Companies cut costs due to lack of funding. Stock market decline. There is also a connection between the bank lending policy and also stock market. The investors get panic. Also, it leads to selling offs. House market collapse, fewer mortgage approvals, lower property prices, government bailouts. Government comes in to stabilize these banks. The real world example, which happened in the year 2008, which led to a great financial crisis. Trigger, subprime mortgage collapse in the US, affect global banking crisis, recession, massive job losses. Response, central banks injected in liquidity, government bailed out banks. Lesson, need for stricter regulations and responsible lending. So these are some of the steps to prevent credit crunches in the future. First of all, stronger banking regulation, ensure responsible lending, risk assessment models. Banker must evaluate both the borrower to mitigate risk. Then government and central bank role. As I said earlier, government and central banks will come in and provide some liquidity in time of crisis. Diversified lending portfolio, reducing dependency on one sector. As a conclusion, credit crunches disrupt economies and financial markets. Lessons from past crises can help prevent future occurrences. Balanced regulation and responsible lending are the key areas. So I hope that you are much more familiar with the term what is credit crunch, and that's it. Thank you.